Hello and welcome to this week's edition of Retire Well, brought to you by the team of Citizen Advisory Group. I'm your host, Kristen Oakley, and joining me in the studio is the owner and financial advisor, Kevin Bucher, and financial advisor, Pete Samanek. We've got a great show for you today. We're going to be talking about strategies for a decreasing interest rate environment. What are we talking about? And most importantly, what does that mean for you? Kevin, Pete, always a joy to be with both of you. How are you today?
Thank you so much. Good. Great being here.
Had us back, Kevin.
What's that?
They had us back.
Yes, absolutely. Well, hey, this is y'all's show,
That's
right?
right. Okay,
I'm very honored to be a part of it. So, well, we need to talk about what's happening right now with interest rates, because what the Federal Reserve does with interest rate policy has a significant impact on our economy. In the last several years, we've been in a much higher interest rate environment, which means one set of strategies, right? And now we're starting to see that interest rates are decreasing slightly. We know that potentially the Federal Reserve might lower them again. So we need to talk about that, because obviously it can be really confusing to know what to do when based on what's happening with interest rates. So to set up our conversation, I would love for you to share a little bit about what those two different environments actually mean.
Yeah, so, I think you look at, there's two sides to this. So one is when we see changes to the interest rates, it's affecting the borrowing rates. So when we're taking out debt, whether that's for our mortgage or a car loan or school loans, so as interest rates are high, you're paying higher and higher interest rates on that. So on one hand, we have the borrowing rates, but on the other hand, we have the savings rates. So savings rates on our CDs, savings accounts, money markets. So when interest rates are high, that's a good thing. But I think there's just a little confusion around why interest rates affect so many other moving parts of the economy, in particular the stock market and the bond markets. And that's what we'll try to peel back and uncover some today.
Right, for sure. And so with interest rates moving forward, what can we expect? I mean, we don't know what's going to happen, right? We don't have a crystal ball, but what are you all seeing right now?
Sure, and that's the important thing, right? We don't know. We don't know as much as the next person or really what the Fed's doing. And what the Fed has indicated is everything is going to be data driven, right? So they're going to wait for the data to come out. They're going to kind of see what the numbers are, and then they're going to kind of react appropriately from there. So most indications, and I think if you asked 100 people, 99 of them would anticipate that interest rates are probably going to be lower between now and possibly the end of the year. But I think looking 12 months out from now, most of the data and the indication says that interest rates will be lower than they are today.